All right, good morning. It is September 4th, 2025, 11 a.m. Investor meeting kicking away here in less than 5 minutes. Mimi, how are you? Hello, welcome, welcome. Welcome. Thanks for joining, Mike. Zach, can you see my screen share? You can? All right, cool. Thanks, Mike. We're gonna give a couple minutes, get a couple more people to get on here. Um, so bear with us. Thanks for joining. Fernando, thanks for joining, buddy. Welcome, Armando. Yeah. All right, we'll give one more minute and then we'll get it going. It'll be five after, so we can start it from there. So bear with us. Thank you. If you can in the chat, let me know where you guys are zooming in from. What city would be a nice little share. All righty, cool. So everybody, we're gonna go ahead and jump in here. Um, Thank you for making the time so we can share some information and spread the knowledge and strategies with investing. So yeah, welcome, welcome, welcome. I'm Mario Montecino from the Montecinos Group, powered by M&M Capital. Can you see the screen? What do you see on the screen? Just making sure we're all good to go. You can throw a comment if you see an image on the share screen. Today is usually I have a partner that runs the host, so it's good to get a little feedback, make sure the kinks, mechanics are working here. Family. All right, awesome. Thank you, Armando. Appreciate it. Cool. There's my family. A big part of my why is the familia there. So I have 3 kids and a wife. Hudson, the oldest one, Cole and Kaya. Kaya was a baby, and now she is 5 years old. So this picture is officially 5 years old. So it's time for me to update that mix. But man, the time goes by fast. Um, when it comes to doing this, and also when I think about that, like how fastly as you acquire real estate, how the time passes as well, right? And hopefully, in what's happened in history, opportunity for appreciation is a big thing for real estate as well. I came across this and I was like, this is a good reminder just to take an image of this chart of like why we're kind of in this real estate game. So, first of all, like how are you guys feeling right now as real estate investors? Like how do you feel as a real estate investor or potential real estate investor? What's you can throw a comment or, actually guys, if you're comfortable, you can go ahead and unmute it. I mean, we have such a small, intimate group today, which it's going to be very interactive, if you want it to. But yeah, feel free to take mute off if you want to share, but just like, or you can throw it in the comments there. How are you guys' feeling towards investing in real estate right now? Does it feel like it's a good time? Does it feel like it's a bad time? Are you guys anxious? Are you guys excited? Just in general, interested in having to gauge, because I know some of the people on here I know personally, so I know you guys are entrenched in real estate on a day-to-day basis, so you guys are kind of boots to the street, active participants. So that, or how would you be, feeling towards your next investment, right? An opportunity on the long haul. It's tight. A lot of people say hard to find good deals, but they're out there. I like that. That's the reality, right? Because of where numbers are, a big thing driven by interest rates, right? And supply, which has been changing, but things are tight, right? It is harder to find deals, but I agree with you, Mike, that they are out there, and I've seen people, on a daily basis, securing good debt. So why? And back to the slide here. So like the wealth accumulation over time. So the biggest piece of this puzzle, you have cash savings, you have real estate, you have stocks and investments, and business ownership and other assets. All these things are pieces to the puzzle for wealth creation, right? But the biggest piece, like the most obtainable piece and biggest piece here, what I see on this chart is real estate, right? So that's what still motivates me to partner up on deals, to lending, financing for real estate, is because that's the biggest piece of the pie for the wealth creation, right? I mean, not to say that you can't create wealth in these other avenues. Real estate is the biggest piece, and one of the biggest things is due to leverage, right? Your ability to acquire an asset with relatively very little down, right? And then that whole asset has an opportunity to value add or appreciate. So I thought that was a cool little chart. Give me a thumbs up if you like that chart, thumbs down, questions. All right. So next one I wanted to bring up was one that I used to put on first time home buyer seminars. And this I thought was a powerful one. And I haven't seen it over a few years. So this is basically homeowners versus renters net worth. And NAR, so National Association of Realtors, puts this data clip out every 3 years, right? And the most recent one, this is what we're working with right now, was published in 2023. And this is basically saying homeowner's net worth versus a renter's net worth is 300,000 versus 8,000 for the renter, right? And this is on average of net worth of basically your equity between, what your assets are worth and compared to your liability. So it's a staggering stat. Like, when you look at that differential on average, 300,000 to 8,000, right? That's a big leap. So whether you're buying your first investment, you're buying your first home, like this piece to me is like, it speaks mounds, right? For opportunity for long term to have that wealth creation build. So I thought that was a good little chart. Any questions on that, guys? Or any comments, thoughts? It's a good visual though, right? All right, so now I'm gonna move into the topic today is creative financing and how to acquire value add real estate, and then also how to hold on with takeout debt for real estate investments without requiring any income documentation. So a lot of my individual people that I work with are self-employed or real estate investors or both, right? And both those have been challenging to secure financing when you're self-employed, when you're an investor and you have multiple properties and complex tax situations. The financing that's my lane that I work with individuals does not require any personal income documentation. And realistically, they look on the value add of the property, your credit worthiness, and credit score is, regarding credit is a piece of it too, but it's really like, hey, what are you buying the property for? What's it going to be worth? Or what is the income on the property? What are the rents versus what is the payment, right? So really kind of simplifies it in that matter, and it doesn't introduce any personal tax returns or W-2s or pay stubs or anything like that when it comes to like traditional income documentation for a loan. So first up, this is some recently funded loans from last month. So this one is a fix and flip investor. This is a property in Long Beach, California. And this was a 2-unit with a third unit, which was a garage, which basically they're going to convert. And this investor, so I've been working with this investor, is actually one of my mentors from college that exposed me to real estate. And he's been in investing in real estate for over 30 plus years. He has partners that he partners up with on these projects. And he doesn't leverage as much. I mean, he's still leverage, but not as much as like programs allow it to, due to like his cycle and how long he's been in real estate, right? He has the liquidity to put more money down, and he's comfortable with that and his partners. So he's putting 22% down on this project. Also, he has 150,000 to rehab the property. So that was a light touch of basically 50,000 for each unit, allocated that to value add the unit. And this was in Long Beach, California, actually off of Redondo. So in a good neighborhood of Long Beach is where that project was. The next one in the middle there is a 30-year fixed loan, right? The first one was fix and flip financing, a 12-month term, a shorter term loan product. This next one is a 30-year fixed loan product. It says DSCR, which is debt service coverage ratio loan. This is a 30-year fix. So this property is in Lancaster, California. He has a heavy schedule of real estate, and he is self-employed. He's an attorney, and taxes are very complicated. And basically, he's not in a position to get loans going full documentation with like traditional tax returns and W-2s. So we did a loan just purely based off the income on the property, which I'm going to do a deeper dive on that, but I just kind of want to high level these different investor scenarios on first, and then I'm going to go back and take a deep dive. But basically, this individual purchased the property, cash, the land, built it from the ground up, the house, and then leased it out. And then now he's coming to me at this point to recoup his liquidity on the investment, right, that he's investing there. So we did on that one about 70% of what the value came in. And the debt service coverage ratio was at 1.326, which is actually very high. So he definitely has more rent than what his total housing payment is going to be. And in this case, he went interest only, taxes and insurance. So I'll get into that and go walk you through the math. But this property is in Lancaster, California. So this is a scenario where it's a ground up construction. So they bought the land, they built the property, and then they leased it out. And then now they're coming back and recouping the funds for that. So that's the middle one. The next one is a leverage play. So this is a fix and flip property in Cypress, California. This is a repeat client of mine. He has a construction crew, and he's just buying property. So this is Cypress, California, so Orange County, California. They put 10% down, and they also received 60,000 in rehab budget to improve the property. And I'll go, and that's the one that I'm going to walk deeper here on the next slide of the numbers are there. So we'll dig in there. Also, I wanted what I have you here. I'm going to post because these are each individual's like personal like scenario. So I'm always curious if you guys have personal scenarios, what that is exactly. And I'm going to give you an opportunity to book because I'm going to post this in the comments. If you guys, later on, when you have more time, we can book a call and we can kind of go over your guys' personal scenario. So that'll be in the comments if you need that, and we'll go from there. So let's dig in. So first, we're going to go off the fix and flip scenario. So they're buying a property, they need to move fast. So we're doing a 10-day or less close. It's a private money loan, and so they're buying the property for $800,000. This is the one in Cypress, California. They're buying it for $800,000. Their down payment 10%, which is $80,000. Okay, and the after repair value came at $1,040,000. Right, so bought it for $800,000. They're going to improve the property, and the similar properties on the market right now are selling for $1,040,000. Okay, this was a single family residence. The total loan amount that they borrowed on that was $780,000. Their initial payments are $5,994. So while they're holding the property, that's what their holding cost is on the property. And I like to just like take a time out because this is why this, leverage is showing like this is a true example of leverage when coming in. So if you're buying a property for $800,000 and you're getting a loan amount up to $780,000, like that's amazing leverage. Like it's very, very close to almost 100% when you look at it that way. And why we're able to do that is because we're underwriting the property off of the after repair value, right? So there is enough equity off a 780 loan amount and the property being worth at $1,040,000. Yes, we're banking that you're going to execute the property. We get comfortable with that because of your track record that we've underwritten. We also get comfortable with that because we know there's money in the budget, right? There's $60,000 for you to draw on as the work is completed. You can draw on that $60,000. So that's why there's a comfort level in that leverage and this type of loan program. So I will say 90%, and programs now are actually going up. I just saw a recent communication up to 95% loan to cost. So a thought on that is there's confidence in the market, right? Because if an investor is continuing to, underwrite these loans to a certain degree, there's confidence that there's going to be appreciation in the market, right? There's confidence in that. And so that leads me to say, like, who has the bigger risk? Somebody putting 10% down or a lender or a bank that's doing 90% of that, right? So there's a lot of risk on the bank in that situation. So their underwrite on the deal is that they're confident in what the market is not going to do. So that's a side note there. So let me give you so that's the actual property, right? Actually, before I go to the next, any questions on that last slide that we went on over? In the comments there. Oh, got it. Okay, so Armando, in there, you had a question regarding does he share with you the methods how to find these deals, these off-market deals? Okay, so good question. Like, all right, these are the deal mechanics of how the financing worked on there, but where are these people getting these deals, right? So there's deals can be found all sorts of places. So I think of aged MLS listings, which is kind of like a overlooked avenue, I think, because usually it's like, hey, if it's on the MLS, it's not a deal. But aged MLS, I think about timing and cadence of these things. Like maybe initially when these people put the property out, they had a certain expectation, and now now that's been sitting on the market for 60 days, 90 days, maybe their expectations change. So aged MLS stuff. I do see a lot of wholesale, right? So wholesale companies lock up a property and then they pitch it to an investor. So typically you're in that kind of scenario, in my experience. And by the way, I've been in business for 20 plus years. And on the wholesaling side of it, it's kind of known you got to dig a lot, right? You got to dig through the deals and underwrite the deal and find it. But I do see a fair amount of deals that have come out from a wholesale, right? Because they're getting them off market. So that's another place that I see people secure the financing. Then the bigger operations, just boots on the street, like realtor referrals, right? The real estate agents that are involved and working with the clients and just having a network of real estate agents that you work with that do find the deals. And then going direct, right? Mailing, contacting the bars. You could have people if you're looking at distressed sales, people access data, for NODs and properties that are showing distress, and then they're reaching out to the client directly. Also, another place is working with like referral partners, like attorney partners, divorce attorneys, estate planning, stuff like that. So that's where possible ways that people could be finding these deals. So this particular borrower, they had a good credit score. They had a 751 FICO. They were a U.S. citizen. They are self-employed. He's actually a realtor and an investor. So he's definitely self-employed. He is a homeowner. He's not a first-time investor, and he did not have a GC, a general contractor license was not required. A couple things to note. So credit scores, typically we need above a 650. At a 650 credit score, the box opens up. This individual had a 751 FICO, so that helps. So they get a little better pricing with the higher FICO. So that's a good thing to know. Also, citizenship status, like we don't necessarily need them to be a U.S. citizen. I do a fair amount of financing for people with I-10, and also experience level. So we work with first-time investors, right, to guys that are super savvy and been doing it for a long, long time, right? Track record, when I think of track record, typically in this type of financing, they look at the last 3 years, right? So how many properties have you bought and sold? Also, how many properties have you purchased and remodeled and maybe hung on to it, right? So it doesn't necessarily mean you have to sell the property. Maybe you just bought it, value added, improve the property, and then we can show that you've done that, and then that counts as a track record as well. So that's the skinny there. Any questions regarding experience or what it kind of takes to get a private money loan for fix and flip financing?
For me,
Yep. Okay, so moving on, the next scenario, I'm going to go over the middle one. So the other component is, okay, now you have a property, you're going to hold on to that property, right? And how do I hold on to that property, right? Because the other loans are typically 12-month terms. Ground up construction could be, you could squeeze it out to maybe 18-month terms. But now I'm going to hold on to this property. I'm not, maybe my exit strategy isn't to sell. Maybe my exit strategy is I value add, I fix it, and I hold on to it. How do I do that? So I always think of a really good option as a DSCR, a debt service coverage ratio. And I'm going to just jump straight to it because a lot of people want to know what interest rates are, right? On these right now, this scenario was 7.25%, I believe, on a 30-year fix cash outs loan scenario. I've seen stuff recently at right around 7%. I'm doing a purchase right now. It's at 7%. They are putting 25% down on a house and an ADU. And I think about that. I think about where Fannie and Freddie is trading right now. They're pretty much right there, right? So it's very, very comparable. So when I say Fannie, Freddie, that means it's a full doc loan. They're showing tax returns and W-2s. So that's what, just to shoot to you straight, guys, and when it comes to pricing of a loan, that's what you're looking at. So in this scenario, they had a appraised value of 525. They did 70% of that loan of value, which that calculates to 367,500. The new mortgage payment, so he chose interest only, so it's interest only for the first 10 years and then amortize over the next 20 years, so a 30-year term altogether. And that payment all in was 2,507. So that's interest only, taxes, and insurance. So he was well over, so he had 3325 over 2507. So he was well over the debt coverage ratio. I will say when it comes to debt coverage, if you can be at 1 or above, you get the best pricing. If you can be at 0.75 and above to 1, you get decent pricing. If you're under 0.75, the good news is you still get a deal, but it's not a, the rates are a little bit higher because there is more risk, right? And then I wanted to calculate the, can you guys see the calculator there?
Yeah.
Okay, cool. I just want to run the debt coverage ratio so you can see it real quick. Let's see here. All right. So we take the rents, so 33.25. So this is the gross rents on the property, and you divide it by the total payment, 2507. That's where you get the 1.32. What if I did that wrong and then the calculation was wrong and I was fully exposed? That was kind of risky for me to put that on the calculator. Are you guys okay if I take a little risk on that? Okay, cool. All right, so 1.32, that's how you calculate. So that's a really good debt coverage ratio. Um, so that's a big winner. Let's go here. So now let's talk about, all right, what is the characteristics of the individual that borrowed that money, right? He had a good FICO. This guy was 751 as well. That's interesting. He was a U.S. citizen. He received the 367,500 in cash out, right? It was all cash out. He didn't, the property was free and clear up to that point. He is self-employed. And he is a homeowner and he's not a first-time investor. You could be a first-time investor on this program. And credit scores on this one, I think go down to about 640, right? Pricing gets hit with a lower credit score. This type of program for a 30-year fixed mortgage, it's more sensitive, like the pricing moves more when it comes to the credit score and also the debt coverage ratio. But when you compare it to like credit scores versus private money versus 30-year fixed DSCR, debt service coverage ratio loans, FICO matters more, right? I would say. Let's see here. So what was what was accomplished in this? So remember this individual bought the property cash in Lancaster, bought it cash. I think he bought it for like under 50K. And then he rehabbed or he built the property from the ground up. And he actually, so he paid cash, but this individual, another experienced guy, actually had a line of credit with a bank, a big line of credit with a bank, and it enables him to navigate. And he purchases the properties with his credit line, right? And then he finances it that way, and then he pays down his credit line with these 30-year fixed mortgages, right? Which is pretty savvy, right? It's not easy to get a credit line with the bank. That's a relationship like built over time for the kind of credit line that he had access to. But a lot of times what I'll see, on the leverage play, I'll see individuals pull a second lien mortgage out from an existing property that has equity, whether it's their house or whether it's another investment properties. They pull that money out in a second lien position, and then they use that for the down payment of the property. So, yeah, that's what on that debt service coverage ratio. So, what do you guys think so far, like about like what are your thoughts about investing in real estate now and kind of looking at these different avenues? Were you guys aware of these avenues? Any questions of these avenues? Any of these things seem like problematic to you, or just any questions in general? Because I would love, for you guys to kind of give questions back. That way you guys get the most out of this webinar. So I want to be a resource and, give you the best value for your time, right? Is the goal there. Let's see. So I have K phone. So what does it take for an investor to qualify by himself with no minimal record? I got it. So track record. So good question. So track record, we can do no track record, right? So meaning you haven't bought and sold a property in the last 3 years, either sold it or kept it or anything. You can actually still do it with 15% down, right? And so if you want to put out this is a good little exercise. So give me a purchase price, like just a ballpark purchase price on a property you would be purchasing.
740.
740. Okay. So you buy
Yeah.
a property for 740. And then how much you think to fix up a property, rehab budget? What number do you want to put out there?
Um, Not clear on that, but let's just go with 75.
Okay, so 75,000 is a good number for a regular single family house that's like 1,500 square feet ish, probably up to 2,000. Cosmetic, meaning you're not adding square footage, you're not adding an ADU. So that's a good start, especially when it's your first investment property. What I would do is not have a crazy large budget and not saying, "Hey, I'm going to add square footage, add an ADU," because that adds complexity. Complexity takes time. When you have time, it gets harder to execute, especially if there's no experience. So I would say if you keep it in that like lane of under 100 or so, that's a good place to start, right? So 740, you said
Is
75,000.
10% like a good rule, or I just came up with that number by
Not
using
necess
10%?
not
Not
necessarily
necessarily.
because I think of that because I think of properties that are like, in the high desert, right? And the purchase prices are lower, right? And 10%
Okay.
is not, it wouldn't be enough to do a project, I would think. Okay, so our
Okay.
total cost is 815. So I'm gonna say you're gonna need about 15% down. So you'll need about 122, 250 in that scenario, right? And you're not gonna need to read tax returns, you're not gonna read W-2s. It's pretty much just a basic application that you would need. And I
Oh,
would
so you're building in the money for the repair,
correct. And then you get 100% access to draw on
the
uh,
75 in this case.
yeah, yeah, exactly. So you get
Okay.
100% of that 75,000. And then let me explain this because a lot of people kind of like it's hard to kind of understand it. So interest on drawn, meaning as you draw down on that 75,000 that we've allocated for you to fix up the property, you have to finish the work first. So like a line item of 5,000 for demo, the demo's got to be in there. Let's say you put in flooring for $10,000 and as that work is completed, then we have an inspector go out there and inspect the property, and then you get in that case that would be 15,000. Then you would get a wire to your account, 15,000, not your GC, not your subcontractor to you, and then you pay it. So you get control of the money for that. And then as you draw down on that, then you'll pay the interest on it. That's why there's a difference between the initial payment and then your total payment as you draw down on the property. Does that make sense so far?
Yes.
Okay, cool. Oh, okay, the other thing I was going to say, like what that property would need to appraise for. So we did give you an idea. So for it was a 700 purchase price and then 770,
740. It was
740,
740.
740 purchase price plus
75.
75,000. Okay. And we're going to do 85% loan to cost. So my total loan amount is 692 divided by 0.75. Okay. So that property needs to be worth about 924,000, right? At the end of the day. So you bought the place for 740, you're going to value add 75,000, and then the properties in the neighborhood have got to be worth roughly 924. It's kind of like how you would do the initial underwrite, right? So and then the appraiser will go out there, they'll evaluate the as-is value. So that's got to come in at least 740. A lot of times I see the as-is values come in higher because a lot of times you guys are getting these things off market and they're a deal. And then they got to be worth it, right? At the end of the day, they got to be fixed up. What are the homes in the neighborhood selling for? Cool. Is
So
that
if the comparables on this one were at 870, you wouldn't do it.
No, that's too tight. Yeah. Yeah, it's too tight. You would need, you know, I don't think that's going to work at any smaller budget because even if it was like a really clean, like the properties, pretty much you just need paint and carpet and light rehab. So let's do that. So 740 plus let's say a 45,000 budget. So very, very light. All right, divided by you got to be at least 890, right? So at least the 890 after repair value for that deal to work. Otherwise, I think it's too tight. Yeah.
So, okay, I hear you. Sorry if I'm wasting everybody's time, but
No, this is good.
what if I just like took it up on myself to do the repairs myself? Not the actual repairs, but financing the repairs out of my own capital. Does that
Yeah,
make a difference?
So here's how I digest that question because we allow a lower down payment option when we're based off the ARV, right? The after repair value, ARV after repair value. So you're able to put a lower down payment, right? Because we're underwriting at the higher value. If you just do a straight bridge loan, you can do 25% down, and then we don't care about the after repair value. That's one way to do it. Or you could, I mean, this scenario, you could just put more money down, right? And
Okay.
you could still, let's say if that scenario works at 80%. So 740 by plus let's still do the 45,000 light budget. So let's do times 0.8 divided by one. And what'd you say the value was? 840-ish?
Yeah, in that neighborhood.
In that neighborhood. So then you go. There you go. So now you can make that deal work. Like if you really like that deal, you're a believer in that, then you're just gonna have to put a little bit more money down. So 20% down. And you get access to the 45,000 to rehab
Okay.
to rehab the property if you wanted. Or you just have the property just, the
Who decides the after value? You do or I do?
the well, you're going to want to do your underwrite, right, on it and make sure you're buying the deal that you want. But we're going to get an appraisal, an as is and ARV appraisal. So the appraisal will assign a value, and that'll help, firm up the numbers on the deal and
I
stuff.
see.
Yeah. Yeah, that's the mental gymnastics that we'll kind of go through on that kind of stuff to help underwrite the deal. As you guys get exposed and you have questions about it, feel free you can either the links in there or book a call, or you guys can call me directly. I mean, I'll put my number in here in the chat as well. Most of you guys probably already have my information. Um, and then let's see. Um, I think is there another question? So Kevin doesn't think
Yeah,
qualified.
Mimi,
Say that again.
Mimi had a question in the chat that I'm curious
Okay.
about. What documents are required for construction
Yeah, so what
fix and
documents
flip
are,
loans, and how?
yeah, I got it. Cool. Thanks, Mike. What documents are required for construction, fix and flip loan, and how long does it take? Okay, so the documents required, guys, is there's no income documentation required, right? I pretty much just need a basic application, which we go over the phone, or you fill out pretty much a 2-page application with like your information. No income documentation. So you have that. If you're buying it under an entity, we'll just need your entity docs, right? So whether it's an LLC, a corporation, or however you're going to hold it, we'll just need those documentation. And then last 2 months of bank statements, like basically where the money's going to be coming from. The other piece is on that, where the money's coming from. We're very lenient with that. So if you have investors that are coming in and they put the money in while you're in escrow, we can work around that, right? So we're very flexible with that. Also, too, I know Fernando's more on the commercial end of it. So we do this financing for multifamily financing, fix and flip financing. So we just recently did one not too long ago for a 16-unit property. That one's a little lower leverage than you think of, like the aggressive 90% loan to cost. On multifamily, we'll do most likely around 80% loan to cost. So they're going to come with 20% down, but they also get access to rehab the properties. So that's a good piece to note. And then other commercial stuff would not have a rehab budget, but on commercial properties, we can do bridge loans where we don't require tax returns and W-2s. And we'll go up to the most aggressive is 70 LTV, and they're all based off the as-is value, so regular commercial properties. And I would say we're really good up to about 5 million, right? So that kind of program is, somebody can't get a loan at a bank. The debt service isn't there. They don't have the financials to show. A lot of time, commercial banks won't want to see your last 3 years financials. So they're not fitting that box. Then we can do a commercial loan for them based off the collateral and on a 30-year fix, which is kind of unique too in commercial. Typically, commercial money moves at 5 year, 7 year, maybe a 10-year, and a 3-year money. This is a 30-year fixed money. So good,
Out
good.
of state available?
Oh yeah, yep. nationwide. These are all
Okay,
business purpose loans, so we can, we can work through all that. So yes, I
okay.
would say to answer your question. But yeah, guys, I wanted to, you know, thank you for your time, and we went a little bit over, but hopefully you guys got good information about. We're going to continue to do these on a monthly basis, if not more. So I'll keep you guys in the loop if you're interested, and feel free just to sign up. And as this thing kind of grows and morphs into more, I'm excited about the journey and see what I can do to pour into you guys and be a good partner.
Thank you, Mario.
All right, guys, thanks so much.